Good afternoon, everyone. I'm very excited to welcome onto today's discussion Mr. Nilesh Shah. Let me start with a quick introduction. So, Nilesh is the managing director of Kotak Mahindra Asset Management Company. Prior to this, he was the managing director and CEO at Axis Capital. And prior to that, he had a decade and a half as the chief investment officer at ICICI Prudential AMC and Franklin Templeton AMC. Nilesh is a gold medalist chartered accountant and a merit rank cost accountant. He has been awarded as part of the teams which received the best fund house of the year three times at Franklin Templeton, ICICI Prudential, and Kotak Mutual Fund. Nilesh, welcome to the show.
Thank you, Adil. It's my pleasure.
So Nilesh, I last heard you speak, I think, a year ago. So you were comparing the outlook for the Indian economy to the Lagan Test match. It was a very, very memorable discussion where you gave us an outlook. I remember it clearly. I wonder if you do.
No, I do remember it, and the message still remains the same. If 136 crore people come together to achieve something, we can move the mountain. In 70s, we were dependent upon food grants under PL 480, and one that point of time India came together. Today we are self-sufficient in food. We were importer of milk. Amul came, India came together. We are the largest producer of milk. So again, like Lagan team, if we come together, we can create miracle.
Makes sense. And Nilesh, I think what I really found interesting about that talk, and we're going to pick up from there, is you've had a ringside view over decades now on the economy and how we can adapt to what is happening in the world today. So the Q1 GDP numbers came out. Now tell us what these numbers should mean to us as Indian citizens, and what kind of outlook should we have going forward?
So one, the first quarter GDP growth is most negative in almost entire history of independent India. Now, this is a big shock, no doubt about it, but it is understandable because of COVID 19. Now, we must convert this crisis into opportunity. And how do we convert this crisis into opportunity? Well, today, world is worried about China and they are positive about India. One gave Wuhan virus, other gave hydroxychloroquine tablet, and possibly vaccines. We must convert this goodwill into tangible benefits for India by way of laying down red carpet to the foreign direct investment. In the 80s, India and China were of similar size. They became manufacturer to the world. We were left behind. Today, they are 5 times bigger than us. Let's get companies out of China to India and help them grow in India so that our growth gets accelerated. When Maruti came, automobile sector became almost 40% of India's manufacturing GDP. We need more such Marutis to come out of China and set up in India.
Fair enough. So you're saying grab the opportunity that the global upheaval is throwing up. If I was to double click on banking, right, again, it was negative, but among sectors, if consumption went down minus 29%, banking and financial services, which we operate in, was less. Can you give us some outlook for what is going to happen on the retail banking side, given what we heard in the GDP numbers?
So by and large, banking system has been impacted less because throughout COVID-19 they were allowed to operate, which was a wise decision. But now banking sector is at a stage where a lot of disruptions are coming. Today, a bank's competition is not another bank, it's actually a fintech. A bank doesn't have to worry about companies headquartered in Mumbai anymore or Delhi anymore. They have to worry about startups playing out in the garages of Bangalore and Chennai and Pune. So, how does bank remain relevant in this world of disruption? Second, banks also will have to go through this huge wave of NPAs, which will come courtesy COVID 19. Whether it's consumer lending, whether it's industrial lending, NPAs are going to increase. how do you restructure those NPAs in a manner where it does not add to the future NPAs, where it does not result into kicking the can down the road will be a bigger challenge. The third and then most important thing is, in a world where interest rates have come down, how do you maintain your margin? How do you maintain your profitability? One way is to expand volume, second way is to cut cost, third way is to provide innovative services for which you can charge. So banks have to reinvent themselves, they have to be technologically savvy, they have to expand volumes multifold times, they have to cut cost, and most importantly, they have to ensure that their credit culture is strengthened in current scenario.
Fair enough. So if you were to double click on retail lending, right, like you pointed out, there have been a number of changes. So it started with a moratorium. So people didn't have to pay for 6 months. Now there is a loan restructuring exercise, which is beginning to start. On the retail side of the book, right, do you think banks are ready for what it will take to restart retail lending? Is there any kind of outlook you have in terms of retail asset growth through the rest of this year?
So my feeling is that compared to industrial lending, retail lending is something which banks are far more comfortable with. And courtesy credit scores like CIBIL, it's possible to, by and large, strengthen your credit culture following just one metrics. So my feeling is that retail lending will be encouraged by the bankers, and for all the people who have a good credit track record, raising money will be relatively easy. It's heartening to note that a real estate developer borrows in market at 24 and 30%, and a housing borrower, a retail housing loan borrower, borrows at 7% and 8%. That's the kind of credibility which retail borrowers have built with the banking system. And most banks will focus on lending on the retail side despite recent challenges.
Right. Let's pick up on two of those points, right? So one is just credit culture. So we've seen a tremendous uptick in consumers, for example, tracking their credit score and credit history. I think it was unknown of 5 years ago. But even at Bank Bazaar itself, right, over 15 million people manage their credit score where they log in, check, and they want to know how to improve it. Would you say the age of credit prudence, right, or credit awareness has come in Indian consumer? What is your view on this?
Undoubtedly, people have now understood the need of maintaining a track record. And I think this is called nudge theory or a network effect, where you nudge people in the right direction. uh, it's difficult to enforce laws and regulations, but it's far more easier to do the nudging. Now, by telling investors that if you want to borrow money at a cheaper rate, you have to ensure that you make the repayments on time, that nudge has changed India's retail culture. It has improved retail NPAs at a level which is significantly superior to industrial levels. In fact, I will dare say that what we did with CIBIL, we need to replicate on the industrial side, on the business borrower side.
Fair enough. And you mentioned that given that the banks are flush with funds, retail will take precedence over corporate asset growth. Now, this is something we've seen. Consumers, even if they didn't have a credit card before, today in the lockdown, they need one because they want to pay for groceries, pay for essentials. People want personal loans, but currently in the moratorium, it's been tough because everyone's waiting and watching. Do you think retail consumers, as the festival season starts, right, and retail lenders will see that entire retail unsecured side start to pick up? Can you just share your views on outlook for retail credit, Nilesh?
So, Adil, we are trying to describe an elephant because it's five blind men trying to figure out what elephant is. But my opinion is that in retail there will be two segments. One who are relatively secured about their future, as they've retained their job, their salary cuts has not been there or has been relatively smaller. Now, this guys will definitely leverage future income for current consumption. That family may think that, oh, we only have car for husband and wife. Now let me buy a car for my teenage daughter who was going to school, who was going to college or job, on public transport, because I don't want his or her to suffer in public transport. So people who are secured about future won't mind borrowing to leverage their current consumption. They may think of moving from 2 bedroom hall kitchen to 3 bedroom hall kitchen, keeping one room spare so that work from home can be done. They may want a bigger LED television because they have to spend time and they can't go to watch movie in theaters. Various reasons will push people to borrow money to spend on consumption. But there is also an unfortunate segment who have lost job or who have lost income significantly. Those guys will be worried about future, and they will be thinking of repaying their loans rather than borrowing new loan to leverage consumption. So we are going to see two different trends playing out. Overall retail lending may not materially improve significantly over next 6 months, but within that one segment will be going up and other segment will be coming down. That is my guess at this point of time.
Very interesting. So you're saying that it's almost as if on the retail consumer side, there are those who are stable and those who are not because of the COVID pandemic, and we're going to see two different trajectories. If I ask you the same question, Nilesh, on the lender side, right? We have the large banks, we have the challenger NBFCs, some which are blue chips, some which are not. How is it going to play out on the lending side? Where are we going to see the most retail growth coming from, and where is it going to be muted?
So again, here two trends will be visible. There will be a set of lenders who will move to digital lending. You won't have to go to their office physically, bearing few exceptions. And the lending will happen far more on the digital side. Evaluation will be based on your social media history, based on the data footprint which you have left in digital world, and based on digital application. Monitoring, disbursement, collection will all happen digitally. This business will multiply manyfold. The second will be banks who have ability to lend. Now, clearly, some banks are perceived to be more safer, and some banks are perceived to be weaker. In some sense, any bank which is able to raise equity capital from market will have investors' confidence on the debt side as well, on deposit side as well. Now, if I'm getting deposits, I will be more than happy to lend. If I'm shrinking my balance sheet, how will I go out and lend? So lending will be dominated by banks which are digitally savvy and which are perceived safer by depositors. That deadly combination will ensure that these players will become significant in retail lending.
Fair enough. I think we'll double click on, the digital way forward. I think that's one set of questions I want to probe you on. But let's just shift onto the mutual fund side right now. So a lot of retail lenders are asking us that, given that the GDP numbers are now out, if I'm not in a rush, I'm planning for an education, it's 10 years away, or I'm planning for retirement. What should I do about my mutual funds given these GDP numbers? Should I even do anything? How would you advise a long-term investor to think through this COVID crisis, Nilesh?
So Adil, my recommendation is that let one quarter GDP number does not alter your financial plan. When we build financial plan for a longer term, we do take into account such mishaps. There will be, financial calamities, there will be natural calamities, there will be medical emergencies, there will be ups and downs on rates, currencies, GDP growth, so on and so forth. What we have to follow is a disciplined investment. Please continue your SIP. If you look at Jan 20 return of SIPs, they were all in double digits. You looked at in the month of March, they were all in negative digits. And for 5 years, 7 years, they were negative. Come August, numbers have become high single digit positive. So please continue your SIP unless until you are meeting with financial emergency. Second, maintain your asset allocation. I met someone, I spoke to someone who redeemed out not because he needed money, but because he saw high mark to market losses when Nifty was 8,000. No amount of my pleading was able to stop him. And the beauty was that he was not invested in my mutual fund, and yet I was pleading him not to redeem. but he somehow or other couldn't get that comfort on my statement. The same guy called up few days back saying, Nilesh bhai, I made a mistake. I should have listened to you. Now what should I do? So please maintain your financial discipline. Don't get swayed by WhatsApp messages or social media, postings. Just trust your advisor who will be able to create a financial plan for you. And you have to invest with ups and downs of the market. There will be always volatility. But if you stay on course through long-term investments and regular investments with disciplined asset allocation, I can assure you, you will achieve all your investment objectives.
Fair enough. So I think the important takeaway is just because these GDP numbers were worse than expected, don't panic. Whatever asset allocation you had prior, stick with it, and you'll be fine in the long run. I think that's a dose of calmness which people will appreciate. Now I'm going to ask you about two of Kotak's specific mutual funds. So one is debt mutual funds, and all the news that has been around on that topic. Your views. And secondly, right, you have a Kotak Bank and PSU debt fund, and in particular, we were talking about what's happening with the banking sector, and that's actually I seen done a 10.1% 1 year pre-tax return. Is it a time to look at that? So, can you just help us understand debt mutual
Sure.
funds and what Kotak's views on that are?
So one Adil, in the month of April, when Templeton announced binding of six schemes, it did create panic among investors. As Association of Mutual Fund, leading mutual fund CEOs came together to reassure investors. And fortunately, after 2-3 days panic, things started stabilizing. Now, number one, I would like to reassure everyone that any mutual fund is a bankruptcy remote vehicle. Whatever assets are there in the fund belongs to unit holders, and no asset management company, no fund manager, no one other than unit holders will be able to access there. So whenever liquidation happens, every single money will come to the unit holders only. Second, in 2008 also, when crisis was there for subprime, one mutual fund had to shut down their liquid fund redemptions. But rest everyone continued to do the business. The same thing repeated in 2020, where only 6 schemes of one mutual fund has been winding down. Other schemes of the same mutual funds are open for business, and all of us have continued doing our business. Third, what happened was a small component of debt fund called credit risk fund, which was 5 or 7% of mutual fund industry debt AUM. Now, in other 90-95% of our AUM, things were normal. In the month of April, May, June, July, August, we have received net positive flows in debt funds. There is redemption only in credit risk fund, but there has been positive flows of more than 1,60,000 crore in all other debt funds between April to August. Another point, people who panicked, they paid a very heavy price. In the month of April, because I got redemptions which was unexpected, I had to go and sell paper in the market. Everyone in the market knew my side, that I am a seller. So they quoted a very, very low price, and I had no option but to sell. In the month of May, I was not desperate seller. Prices immediately started appreciating, yields came down. In the month of April, credit risk funds on an average would have lost 24% annualized. From May, June, July, August, we have delivered 20% annualized return. So people who stayed back have made money. People who panicked have lost money. So limited point of all this story is that one, trust your advisor. He knows that which are credit risk funds, which are not so heavy on credit risk. It knows which companies will be able to sustain their business through the ups and downs. It knows which companies could be in trouble. And most importantly, it will tell you when to redeem and when not to redeem. Now, coming to Kotak Mutual Funds, our debt investment principles are very simple. SLR, safety first, liquidity second, and return third. So I'll rather give you 10 basis point lower return, but I would like to earn on portfolio where there is limited credit risk. And that strategy has paid us well. Uh, Banking and PSU debt fund is one fund where we are investing, as the name suggests, in public sector companies and banks, which are public as well as private. From a credit risk point of view, it is far lesser. And this fund has done extremely well over last 1 year and last 3 years and last 5 years. But certainly this is meant for conservative investors who want limited credit risk. And with a 3 year horizon, this is one fund which should be there in every conservative investor's portfolio.
Understood. So, appreciate that background on what's happening with debt funds and in specific the Kotak banking and PSU debt fund. Now, I'm sure that, you have a difficult choice here, but I'm going to push you to say that if I'm 30-year-old with 1 lakh to put away now in a mutual fund, and it's a long-term investment for an education of a child, if I had to pick one Kotak fund, right? Which fund should I pick now for a long-term investment and why?
Sure. So Adil, all 30 years are not alike. The investment objective is the same. So let's say a 30-year with Virendra Sehwag mentality in terms of betting, he should go for Kotak Small Cap Fund. It's high risk, high return fund. Small caps are cheap and it can deliver great return. Now let's say there is someone who is 30-year-old with Rahul Dravid mentality, safe player, solid player. He should go for Kotak Balance Advantage Fund, which divides between debt and equity, where volatility will be lower, but the returns over a cycle could be ranging between fixed income plus to almost equity minus return. So depending upon your risk profile, you choose Kotak Small Cap Equity Fund or Kotak Balance Advantage Fund.
And Nilesh, when you were 30 years old, were you like Sehwag or were you like Dravid?
Oh, Adil, I'm more like Dravid minus. I'm a very conservative investor. And somewhere, when I started my career in investing in 91, courtesy Harshad Mehta, I lost all my money. I lost a lot of money at that point of time, but in today's terms, it was affordable loss. And that gave me guidance to follow what Warren Buffett says. Rule number one, never lose money. Rule number two, never forget rule number one.
Fantastic. So now we move to the last part of our discussion, Nilesh. So earlier you were telling me, right, and this is data we're seeing at Bank Bazaar also, that almost 100% of your transactions today are digital. Your AUM is at an all-time high. Now, as a macroeconomic expert and watcher, right, is India going digital, or does India need to go digital very quickly if we want to recover fast? Just talk us through the digital economy.
Undoubtedly, Adil, the future is digital. It helps reduce cost, it helps increase the reach, and it brings convenience. This is deadly combination. Now, of course, everything can't be digital. There will be certain services, there will be certain features which will be in physical format. So it's not 100% digital, it is coexistence between physical and digital. But we need to accelerate digital adoption because in a country like India, it brings real democracy, it brings reach, it reduces cost, it improves its productivity. And in financial system, digital is must. Today, Adil Bhai, there are so many people who still go and invest into chit funds. They invest in collective investment schemes. They invest in jewelers who run away. Every week you hear one news or other about people losing their money. Now, how do we ensure that such leakages are stopped, such losses are avoided? The answer is digital adoption. If banks, insurance, mutual funds, which are regulated, reach out to all these people with appropriate education, they won't get into the traps of chit funds and collective investment scheme. So in financial system, in financial sector, we have no option but to accelerate digital adoption. Obviously, digital will have its own challenges. Security risk will be there, making people familiar with adoption of digital will be there. There will be some old and young people who may not be as savvy on digital side, but those are all the challenges which we need to manage in order to create far more productive India. This is something which can change India's growth orbit.
Yeah, absolutely. I think, we've seen, for example, in video KYC, what used to take 3 hours now takes a few minutes. It's incredible. Instead of traveling for 1 hour, meeting for 30 minutes, traveling for another 1 hour, now everything happens within a few minutes. And it's an eye opener for both the lender and for the consumer. Are you seeing something similar on your side?
Absolutely, and I would like to quote one, foreign magazine, which generally gave anti-India view. So when the reporter was in India, he could never find anything good in India's banking system, and all his articles were negative. Then he was posted to France, and the first tweet which he made from posting in France, that in order to transfer money from one bank account to another bank account in France, it took him 7 days, and he was able to do it in India courtesy IMPS instantly. So we are light years ahead of France in banking system. This is the positive part of India's banking system. Now we must ensure that it reaches out to entire India, not just urban India, but also rural Bharat.
Yeah, absolutely. And my last professional question. So you've said that when it comes to banking, it's also about access to capital. So my question now, right, is as we reach out and reach the last Indian in every single town, in every single pin code, are the winners going to be the existing large incumbents? Is it going to be the challenger fintechs, or is it going to be collaborative? Like, how is this going to play out in the next 3 years?
I think Adil bhai, people who will be adoptive, they will survive. If you are dinosaur, but you are not going to change, you will get extinct. Only cockroaches will survive. Or there was a very famous book, The Paranoid Will Survive. So in our context, companies which are adoptive, which can coexist in physical world and digital world, which can have good credit culture, which can build trust and confidence through their customer centricity. All these ingredients will be extremely necessary. It will be fashionable to say I am now digital company, but behind that digital setup, you'll have to require conservative banking culture. You cannot survive without that conservative banking culture, without that customer centricity, without that trust and confidence which depositor needs to have in you. So all those ingredients packed under digital ecosystem will be the characteristics of a successful financial services company.
Fair enough. Fair enough. I think that's very insightful. Now we're coming to the last part of the show, Nilesh. So, in addition to being an industry leader, you also are a family man, a parent. A lot of people are going through a lot of anxiety as we go through this COVID crisis, especially about their financial matters. Is there any word of advice you'd like to give people watching in terms of how to steel themselves and manage through this tough phase?
Definitely, there are just three guru mantras for creating wealth. Be a regular investor. In some sense, our proverbs, small drops of water make an ocean, is applicable here. Second, have a disciplined asset allocation. Don't chase past return. In Jan, equity past returns were looking good. That's not the reason to invest in equity. In March, past equity returns were looking miserable. That's not the reason to stop investing in equity. Maintain the disciplined asset allocation. Our proverb of don't put all eggs in one basket is applicable here. And finally, you have to have patience or long term investment. Overnight successes aren't created. Years of blood and sweat goes into it. You don't get a mango by planting a mango tree. You still have to water it for 12 years before you can get good mangoes. So remember these three proverbs, small drops of ocean make in water, do regular investment, don't put all eggs in one basket, be a disciplined asset allocator in debt, equity, gold, offshore assets, and real estate, and be a long term investor. if you wait for 12 years, you will get good mangoes.
Thank you, Nilesh. I want to thank you for giving us, starting from a macro view, a deep dive into what individual investors should do. And more than anything, for leaving with me the thought that I've got to decide if I'm a Sehwag or a Dravid before I buy my mutual fund. I never realized that before. But thank you so much for your valuable time. We really appreciate it. Thank you.
Thank you, Adil.